Let's stay on the markets here and bring in Kathy Jones, Schwab's chief fixed income strategist. Kathy, always good to see you. Certainly want to talk about the Fed, big day for all things Fed, but I do follow you on Twitter, and you put out an interesting tweet highlighting some of the action we've seen this week for fixed income of bankrupt companies and just the moves in these equities like a JCPenney or a Hertz. Can you explain to investors why that is happening? And does it make any sense for investors to jump in there and buy stocks of bankrupt companies?
No, it doesn't. And you know, as someone who studied corporate finance, of course, when a company goes into bankruptcy, there's little left over usually for equity holders. Now, there may be something left over. There may be some residual value. There may be some sort of restructuring. But typically, you know, what happens is the equity investors get very little, if anything. So it has been an interesting time for those of us who are sort of more traditional in our study of corporate balance sheets and the way bankruptcies work. But clearly there's some speculative fever going on right now. Money is cheap, trading is cheap, people apparently are bored, and this is what they're doing.
Yeah, sticking with that, Kathy, you have turned pretty cautious on high yield right now. Tell us why that is.
So we're still neutral, meaning we think if you have a 10% allocation or a 5% allocation, you can stick with it. But it's moved very far, very fast. So we're almost back down to the levels we were at prior to the big spike in March. And yet not that much has changed for a lot of these companies that find themselves with a certain amount of stress. Now, interest rates are lower, so that may help them roll over some loans. But clearly the economy's in a deep recession. And I think a lot of people have just rushed in because the Fed is buying corporate bonds. They bought some ETFs and high yield. And so it's lifted all boats. And now's the time to be more discriminating, we think, than just buying everything.
Kathy, you think the Fed is partially to blame for some of this speculative activity we are seeing in the equity and even the debt markets?
Well, look, when the Fed is very easy and expanding its balance sheet and there's excess money floating around, a lot of times it will go into asset price inflation. And there's obviously excess liquidity. It's finding its way into corners of the market, and people will take advantage of that. Clearly, that creates a lot of risks out there, mostly for some of these investors who aren't really clear on what they're doing or may need to be more nimble than they're able to be. But this does happen. If there's no other productive place for the money to go, it's going to go into financial markets, and we're going to get this sort of speculation.
Would love to get your thoughts, Kathy, on some big-time investors and what they're saying about the market. You've got fund manager Paul Tudor Jones saying that investors who have been cautious around the stock market, in his words, have been confounded by the recent rally. And he says it might be time for some people to eat humble pie. What do you make of that?
Well, yeah, I think a lot of investors have missed the move. It went so fast and pretty much reversed the decline very, very quickly, much more quickly than I think most people anticipated. And it's inconsistent with the economic data that we're seeing. Now, that's not unusual. The market and the economy aren't the same thing, but it clearly has run very fast, very far relative to what I think most traditional investors would have anticipated.
All right, Kathy, I promised a question on the Federal Reserve. What are some of your expectations ahead of the meeting later today?
Well, we're not looking for a policy change. I think the interest will be around the projections that the Fed releases and whatever Powell has to say. So the projections, we're assuming they're going to have to bring down their growth and inflation expectations. It'll be interesting to see when they talk about the longer run, where they think we're going back to. But we think that the dots on the dot plot will probably indicate the Fed's not going to raise rates until about 2022, maybe beyond. And then it'll be interesting to see how Powell frames the situation. Clearly, there's some growing economic optimism out there as we reopen. But I think he's still going to be relatively gloomy about the economy because unemployment's in double digits. Inflation is way below the Fed's target, and there's a lot of work to do to get the economy back on track.
Do you think he'll talk specifics on ways the Fed can possibly do more, and what might that look like? Might they expand their bond buying program? Might they actually put a timetable on that program as well, something they haven't done up until now?
I think it might be too early for more specifics because things are going well. The Fed still has plenty of ammunition in the facilities that they've created. To date, they haven't really had to tap them very much in order to get the markets have responded just from the signaling. And I think that they probably want to leave their options open. I do think the next logical step will be yield curve control if it becomes necessary. But this stage of the game, it doesn't seem necessary. And on forward guidance, why get specific if you don't have to? If things are working for you, why do that and then maybe create some disruptions in the market? So I think all that's probably coming, but it's coming down the road maybe in the fall.
Kathy, we have seen coronavirus infection cases spike as states have reopened. If there is that second wave later this year, what's the likeliest course of action for the Federal Reserve? Do they go back in there and take up their balance sheet, which is ballooned? Do they expand it even more?
It's possible. One of the problems is, a second wave, what is the reaction to it? It doesn't seem to be a lot of political will to shut down the economy again. So that may not have the economic impact that the first wave has had. Or it's possible that consumers just get cautious and pull back and say, well, even if there's no shutdown, we're not going out, we're not going to restaurants, we're not doing anything. And then the Fed would have to deal with the decline in consumer spending or the slowdown in consumer spending. So, yeah, I think they probably increase the balance sheet if necessary. They engage in yield curve control if necessary. We've certainly seen that they've been willing to be very creative. So there may be some new facility created to target certain industries, certain areas of the economy that might be softening at that stage of game.
And before we let you go, what are your thoughts on other areas within the debt market, corporate debt, maybe a municipal bond market? Are you seeing some opportunities for retail investors there?
Well, our general view is that we should stay a little bit shorter in duration and move up in credit quality. And so that for us means sort of finding some of those nuggets where we think we're going to succeed, or the companies that are going to succeed, the municipalities that are going to be able to bypass some of the major stress. The other area that we're seeing some opportunity might be in preferred securities, kind of a hybrid stock and bond securities, because we think that generally speaking, they are issued by bank finance companies. Those balance sheets are pretty firm. So as long as they're allowed to pay those dividends, we think that if you're looking for sort of an aggressive source of income, that's one area to look in.
All right, we'll leave it there. Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Always good to speak with you. Keep that Twitter feed going strong.
Okay, thanks.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.